Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our educational webinar. Our topic this evening is different investment possibilities with a self-directed retirement account, so I hope you'll find this interesting. As we get started, I do want to give you a bit of information about Security Trust. We are a retirement plan administrator only, so we don't provide legal, tax, or investment advice. We also don't represent or endorse any particular investments. We are not a registered investment advisor, so we don't sell securities or investments, and we don't represent or endorse any investment opportunities. And I will be talking about a number of them this evening. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts. We're going to talk about the benefits of self-directing and the guidelines that must be followed in all retirement account investing. I'm going to give you some detailed information about the LLC structure that we use for each of our clients' accounts. And then we're going to talk about some creative investment possibilities. I will enumerate and elaborate on STC's services, and then I will open the floor for your questions. So we'll go ahead and get started. First, with a definition. What do we mean when we say self-directed retirement account? And what we mean by that is that you hold your account with a company that permits you to choose any type of investment that is allowed by law. And that means including what some consider non-traditional assets like real estate. Self-direction also means that you are going to manage your retirement plan's investments, and you're going to have control of the decisions that relate to those investments in your account. For example, if you own a rental property, you will be the one to decide what the rental rate is, to approve renters, to decide if you are going to renovate or upgrade appliances. You will make those decisions that relate to the investments in your account. Now, there are different types of retirement plans. I have traditional IRA and Roth IRA on your screen right now. These are commonly known. The thing that's the same about them is that their annual contribution limits are the same. You can contribute $6,000 from your earned income and an additional $1,000 if you are 50 years or older. The big difference between these two accounts that's pretty significant is that contributions to a Roth IRA are post-tax. So that means that you're going to go ahead and pay taxes on the amount that you contribute to the account. However, when you begin taking distributions, qualified distributions, once you reach retirement age, those amounts, those distributions will not be included in your taxable income. So it is an opportunity for the growth on the investments that you have in a Roth account to really earn tax-free. So that is the big difference between a Roth contribution and normal regular contributions. Most of them are pre-tax. A SEP is a Simplified Employee Pension Plan. This would be a plan that is on a business. So if you're a sole proprietor or small business owner, you may qualify for a SEP. And the contribution amount annually is significantly larger because it is from the business earnings. And in 2022, that amount was increased. Your maximum contribution for a SEP IRA is $61,000. So that's up $3,000 from last year. A simple retirement plan is a savings incentive match plan. I've seen that used by a sole proprietor and by small partnerships. Different types of entities might use a simple plan. Its contribution limit for 2022 is $14,000, and that's up from last year as well. And now I've brought out onto your slide 4 plans that say former employer. So a 401k is a corporate plan, for-profit corporate business. 403bs are often used by nonprofits or charitable organizations. TSAs are tax-sheltered annuities. TSPs, thrift savings plans. If you formerly worked for an employer and participated in one of these types of plans, then you can move the money out of that plan into a plan that you qualify for, say a traditional IRA, and then if you liked, you could self-direct those monies. If you are currently employed, then you will need to go to the administrator of your plan and see if you are eligible to move any monies out of that plan into a plan that you can self-direct. A solo 401k plan is a newer plan, although it's now been around for a while, and it was designed for sole proprietors, individuals who are in business for themselves, pretty much by themselves. A spouse can be included in that business, but really, basically no employees or very, very limited part-time employees. And a solo 401k plan permits the sole proprietor to make both an employer and an employee contribution, and to have a Roth portion of that if they like, and to also have a loan provision. Sometimes small business owners need loans, and that's a nice feature of a solo 401k. So if you are a sole proprietor and you might be interested in getting more information about that, please do let me know, and I will be happy to get that information to you. Now, I want to talk briefly about why you might be interested in self-directing. And one of the primary reasons is that you can truly diversify the assets that you are holding in your retirement portfolio. You are not limited to stocks and bonds and mutual funds. And we just see that there's a lot of volatility sometimes in that market. And so most financial planners and advisors recommend that you diversify into different types of assets. So with a self-directed plan, you can do just that. You could actually hold real estate in your retirement account. You could also lend money or purchase mortgages, notes. You could own private businesses. So you really can diversify, and that may be of great benefit to you as different markets fluctuate up and down. In addition, as I mentioned, you're going to choose those investments, and you are going to control the decisions related to those investments. If you are interested in real estate investments in your retirement account, you can increase the buying power of the dollars that you have in your account by using leverage. In other words, your retirement account can get a loan to purchase real estate. Now, there are some specific requirements about that loan. It must be a non-recourse loan. You can't personally guarantee it because it is your retirement account that is getting the loan. But it does permit you to borrow money and use other people's money to fund an investment for your retirement account. So because of all of these things, you may be able to experience a higher return on your investments in your self-directed retirement account. Now, there are guidelines, there are rules that must be followed. The IRS, the Department of Labor, the ERISA laws, all of these come into play with retirement account investing. So there are guidelines for all retirement account investing, and one of them is that there are administrative requirements for the account. An annual valuation of the retirement plan must be made, and an annual report submitted to the IRS, a Form 5498. Detailed books and records of all of your transactions, monies in, monies out, contributions, distributions, all of those things must be maintained in detail. State filings may be required depending on what you own and what state you own it in. And in some rare cases, tax returns could come into play. That would be if you had an investment that triggered UBIT, unrelated business income tax, or one that triggered UDFI, unrelated debt financed income. Those are pretty rare transactions, so I won't elaborate on those right now. We do have previously recorded webinar on our website where you can learn more about those taxes if they were to come into play. Now, STC is a full service administrator. So we will fulfill all of these administrative requirements for your retirement account. With one exception, we are not permitted to prepare a tax return if that came into play. But what we would do is we would give you, your tax accountant, all of the detailed records and documents that would be needed if your retirement account did need to file a tax return. So really, we're going to provide all of that administrative support for you so that you can focus on investing your retirement account funds. Now, in addition to those administrative requirements, there are some additional guidelines that must be followed. There are some assets that are prohibited. One of those is life insurance contracts. With one exception, a solo 401k plan can own a life insurance contract. In addition, no retirement account can own collectibles, rugs, works of art, stamp collections, coin collections. Now, I do want to make a distinction here because precious metals can be a viable investment in your retirement account as long as they meet the rules relating to precious metal investing. But we're talking here about coin collections, that kind of thing. Those are not permitted. In addition to those prohibited assets, there are some transactions that are prohibited. Your retirement account is given basically tax-deferred treatment. You're not paying taxes on the money that you contribute to it unless it's a Roth account. And its purpose is to provide income for you at retirement. So you do need to be engaging in transactions that benefit the retirement account. So a prohibited transaction would be one that is not for the exclusive benefit of the plan. You also cannot borrow money from your retirement plan. You cannot pledge your plan assets to secure a personal loan. You also cannot utilize your personal credit or guarantee to obtain a loan for the plan. Now, I told you that you could use leverage in your retirement account, and you can, but again, it cannot be a personally guaranteed loan. It must be a non-recourse loan. You also cannot benefit any disqualified person with a transaction that you're engaging in. So let's talk a little bit about who those disqualified persons are. And you'll see the first person that I show on the screen is you. You and your retirement account are distinct entities. So you cannot do a direct transaction with your retirement account. And let me tell you and I'll give you an example to help you understand that. Let's say that you personally own a vacation rental property in Myrtle Beach, South Carolina. You cannot sell that to your retirement account. That would violate this disqualified person's rule and be a prohibited transaction. And if you are married, this includes your spouse. If your spouse owned that property, your retirement account could not purchase it from your spouse. There are other family members who are also disqualified. Ascendants, so that's parents, grandparents, great-grandparents on up the line. Descendants, that's children, grandchildren, great-grandchildren on down the line. Those are all disqualified persons. So if your father owned that vacation property, your retirement account could not purchase it from him. If your daughter owned it, your retirement account could not purchase it from her. However, lateral family members are not disqualified. So that would include brothers and sisters, aunts and uncles, nieces and nephews, cousins. So none of those people are disqualified persons. So if your uncle owned that vacation property, your retirement account could purchase it from your uncle. So just some things to think about when you're thinking about who you might be transacting with in a retirement account investment. There are also two entities that are disqualified persons. Any company, if you are a majority shareholder, and that does not mean over 50%, it means a majority. So if there are 3 owners, if you own more than 33 1/3%, you're a majority shareholder. Also, any company, if you are an officer, a director, or a highly compensated employee. And if you need to know if you're highly compensated, you can look up those rules on the IRS website to determine how that's calculated. So these persons are disqualified from direct transactions with your retirement account. Now, those are some of the guidelines. Let's talk about some of the benefits of the structure that STC uses for each of our clients' accounts. And what we do is our operation department, when they're setting up your account, they create a specialized LLC in the state of your choice, and that LLC becomes the investing vehicle for your retirement account. It is not a generic LLC. It is specifically designed to be owned by a retirement account. And using that LLC structure gives you a number of benefits. And one of those is it gives you maximum flexibility when you're structuring complex transactions. So you may have a transaction where you have multiple parties to the transaction. Maybe you're also using leverage. Maybe one of the parties is making a non-monetary contribution to the transaction, and so they are going to benefit from the investment in a different way. So all of those things potentially can be accommodated using this LLC structure. So it does give you a great deal of flexibility. It does provide an additional layer of asset protection. It is a limited liability company, albeit a specialized one. It does give you checkbook control over the retirement funds in your account. So you have immediate response to investment opportunities. We know good investments can come and go very quickly, and you need to be able to move on them. So what we do, we actually do not give our clients the checkbook for their account. Rather, what we do is we review the transaction documents, and if everything is compliant with the IRS rules, then we will send the money to the seller of the transaction. So you have our experts reviewing your transaction, and we can same day or next business day fund that transaction. So it's a very quick turnaround once we've reviewed your documents. So it's a protected checkbook control. You have the safety of experts reviewing your transaction before you actually engage in the transaction. I should mention here that the penalties for violating the rules can be severe, up to forfeiting your retirement account and making it all immediately taxable to you. So it is important that you understand the rules, or you have us overseeing, helping you with your transactions to make sure that they are staying compliant with the rules. They can be complex. Using this structure also simplifies asset titling. The assets will actually be titled in the name of your LLC and not retirement account number 12345 for the benefit of John Smith, but actually in the LLC's name. This also means that if you are purchasing real estate, you can go to the closing and sign the documents on behalf of your retirement account, because you are you're the investment manager for the LLC. So you can sign on behalf of the LLC. So it makes purchasing and asset titling and asset transfer very straightforward. This also eases pooling or partnering with other funding sources. We have many clients who go into investments that they don't solely own, that there are other owners as part of those investments. So pooling or partnering with others is made very simple when you are using this structure. And speaking of partnering with others, you can actually partner with yourself, with your own personal investing funds, with a spouse's retirement account, or those otherwise disqualified persons, if you partner with them at the inception of the transaction. And so what I mean by that is, let's say it's your retirement account and your spouse's retirement account, and you want to co-purchase a piece of property. The inception of the transaction is when you actually purchased from the seller. So the two retirement accounts are purchasing from the seller. They're not in any kind of partnership prior to that purchase. So it's the inception of the transaction when they are partnering. So that is permissible, and our client services department can help make sure that you can structure the transaction properly so that will not violate the disqualified person rule. You can also invest with colleagues. I've spoken at many real estate investor meetings where different people might be interested in co-investing together in some investment that they've learned about. You can invest with LLCs, investment syndications. So different ways that you can partner with other entities and co-own an investment. Let me just show you a quick little schematic before we get into the different types of investments that you might want to think about. You'll see on this schematic on the upper left, current custodian. So this would be where you are currently holding your account. You would, if you want to set up an account with STC, you would complete documents that would direct your current custodian to transfer or roll over funds in your account to our self-directed custodian. Then our operations department would be setting up this LLC in the state that you choose. Once the money reaches our custodian and the LLC has been set up, then the LLC ownership interest will move to the custodian. They'll hold that in your account, numbered account with them, and your funds will move to a bank account that your LLC has access to, and then you're ready to begin investing. So in this case, you have 3 investments in your retirement account. Investments 1 and 2 are wholly owned by your retirement account, but investment 3 has 3 other owners. You're one of 4 investors. And you'll see that investor number 1 is your father, investor number 2 is your daughter, and investor number 3 is some of your personal money outside of your retirement account. Those would normally be disqualified persons. However, again, if you co-invest at the inception of the purchase transaction, this is a viable transaction. So again, our client services department can help you understand exactly what that means and how to make sure that the paperwork is titled correctly so that it will be a viable transaction. Okay, let's talk about choosing an investment. When you have a self-directed retirement account and you're working with an administrator, a company that permits you to invest in anything that is permissible by law, you do have a wide range of investment opportunities. I've just brought out onto the screen a number of different types of real estate that you could invest in. Single or multifamily homes, vacation investment property, tax liens, raw land, building lots, even commercial buildings and real estate syndications where you would likely be in a pool or a partnership with other investors. Mortgages and loans, you can actually purchase mortgages and you can make loans from your retirement account. Precious metal investing is permissible. You can also invest in private businesses or operating businesses. You can invest in the Forex market, options, futures, and of course you can always have a piece of your self-directed account in stocks and bonds and mutual funds. So spreading investments throughout all these different types really will diversify your account. Let's talk specifically now about some client investments and some example investments that we have heard about and seen. Now this client investment was a purchase and then a rehab of a purchase of real estate and then a rehab of that property for sale. The individual had $500,000 in a self-directed retirement account with us, and the property's purchase price was $330,000. She spent $140,000 to rehab this property, and then she sold it, and for a profit of $85,000. Now, this client is a real estate investor, so she's using her real estate investing expertise with the funds in her retirement account. And I understand that she then, once she sold this property, she went and she looked for another property that she could invest in. and perhaps rent or hold for appreciation. Now, this is also a real estate investment. This client invested in real estate, but to hold it initially as rental. So she purchased these rentals for appreciation. She also had $500,000 in her retirement account, and she purchased 2 rental properties. She put approximately $500,000 down, and then she funded the remainder of the cost of those properties with non-recourse loans. Now, at the time when she first started, she was renting these properties for break even, so they were paying for the loan and the cost of the loans, and just a small cash flow. She was holding them for rental and then for property appreciation. And I actually don't know the final outcome of that investment. Real estate in foreign countries is permitted. We have had a client who invested in a vacation condo in Costa Rica. Now, let me just make a statement here. Remember that you and your retirement account are disqualified persons. You're a disqualified person to your retirement account. So if your retirement account owns a vacation condo in Costa Rica, you and your family can't go and use it. That would violate the rule. Now, your brother or your sister could, or your aunt or your uncle, because remember, they're not disqualified persons. But you do need to keep in mind that if this is an investment property, this is not for your personal use. Another client invested in a land development opportunity in Mexico. Now, this is a very interesting client investment. This individual had expertise that he was using in his, it was actually a Roth account. He had $11,000 in a Roth account. And what he did is he purchased building lots for commercial building lots for between $5,000 and $10,000. And then he marketed those lots, those properties, and sold them. And in 18 months, he did 9 transactions. He increased the retirement account value to over $300,000 in that time period. And then my understanding was that he used that cash to purchase a commercial strip mall, taking out a loan on the property to invest in other opportunities. So he was using an expertise that he had. So if you have real estate expertise or expertise in lending or operating businesses, you can use that to your advantage in your retirement account investing as well. Now, this is an example investment of building lots. And this is a builder that had a 30-lot subdivision that was 50% complete, and he experienced financial difficulties. And I actually know of some builders who are in this situation currently because of difficulties in getting materials. So this builder is putting the remaining lots for sale at $30,000. So you and 4 other investors pool $100,000 each, and your plan is to hold those lots for 3 years and then sell them for $60,000 each. So let's look at the calculation in this example. The purchase price would be those 15 lots times $30,000, so that's $450,000. You had 5 investors, each investing $100,000, so you have $450,000 going for the purchase price. And then you've got $50,000 to pay for costs to carry those lots, taxes, whatever might come up in those 3 years. And let's say at the end of those 3 years, you sell those lots for $60,000 each. That's going to give the 5 investors a total $900,000 proceeds. Divide that by your investment, you'll have $400,000 over 3 years. Divide that by 5 investors, so each investor would have earned $80,000 in that 3-year period. So that's an example of partnering with others in an investment and sharing in the profits, not having to fully fund an investment yourself. This is a client investment where he did a guaranteed loan. So his retirement account makes a loan. The client actually transferred $100,000 into a self-directed account with us and then loaned that money to a real estate investor for a guaranteed return of 10%. So he was getting 10% on his loan. And there was a promissory note. Now, you as the lender, the retirement account owner is the lender, you would be able to ask for security for this note, and then you could put a lien on whatever the secured asset was. So those terms, the percentage, the length of the loan, all those terms would be up to you and the borrower. But you as the lender could make that decision. This investment, we had, I think a couple of clients did this investment. They invested in a loan pool. So the clients contribute $50,000 to this loan pool, and it is a company that lends money to professional rehabbers, and they have first position on these properties in their loan. So it's secured by the properties that are being rehabbed, and then the net earnings on these loans is paid to the retirement account quarterly. I do not know what this is currently making, if this is still an investment that's ongoing. At the time that I looked at it, it was earning 12% annually. So again, you can find different types of investments and see which ones will benefit you the most. I found this a very interesting investment. One of our clients invested in oil, natural gas drilling. The retirement account invested $35,000 in a syndicated oil, natural gas drilling project, and the company was doing 5 drills, and there would be an additional $5,000 to $10,000 investment to cap any wells that were discovered, that were found. And the investment would be lost if no oil or gas was found. So there is certainly risk associated with this type of investment. In this, and of course, if you strike, then you receive royalties on producing wells. And this particular client, they had strikes on the first 2 drills. So now his retirement account is earning royalties as these wells produce over time. So another type of investment that you could consider. This is an example investment that we put into the presentation just to help you understand that there are cases where you can assist a family member and still be benefiting your retirement account, and it's a viable transaction. This example is a loan to a cousin to purchase a home. She's gone through a recent divorce. This has upset her financial stability, and she can't qualify for a loan on her own yet. She needs a couple of years to get back on track. So the purchase price of the home is $150,000. You give 10% down. She has 10% down from the sale of her prior home. You look at this situation and you see the neighborhood is experiencing good price appreciation. So you offer an interest-only loan at 8% with principal due in 2 years. You would be helping your cousin, and you would be earning nearly $11,000 interest per year. And you would likely want to secure that by the real estate, so you would also have a secured position for your loan. So this is just an example that shows that it is possible to help a family member while still benefiting your IRA. Now, this is an example of an investment in a private business, and we do have a client who does invest in private businesses and, does research and understands when those might be good investments. I will say that you can find business brokers and such to help you with this kind of investment if you're not familiar with it. But in this case, this was an investment to fund the expansion of a furniture business. The neighbor had a profitable store. This this client's neighbor had a profitable store and he wanted to expand. And the neighbor needed money for inventory and working capital. So your retirement account invests $50,000 for a 1/3 profit interest. The new store makes $100,000 per year. I mean, he already had a successful store. The new store is up and running quickly, and your retirement account earns $33,000 per year. You sell your interest in year 5 for $75,000. Your earnings over that time period would have been $190,000. Your account value grew from $50,000 to $240,000. So again, you can make this type of, you can determine the terms, the interest rate, the length of the contract, whether it's for interest or this was 1/3 of the profit. So that was, if a company didn't make a lot of money, then your return would be lower. Again, those are things that you can research and determine how you want to set the terms of this type of a business. This was a group investment that some clients participated in. This was a syndicator who purchased properties throughout the country, and he set up LLCs or partnerships, depending, with small groups to invest in those properties. And they were usually mixed-use buildings. So they might have some residential and some retail. Individuals would invest anywhere from $100,000 to $120,000 each. So he would have a number of investors in a syndication. And one thing that this does do, if you have a couple of $100,000 in your retirement account, you might not want to put all of that into a single investment. So if you are participating with other investors, it might allow you to have a smaller portion at risk in a particular investment, and or let you invest in another type of investment and diversify. So that is one nice thing in not having to wholly fund an investment. This was a developer who purchased high-rise buildings in metro areas, and then he converted the properties to condos. And I hear this is being done a lot. And the investor would buy a condo for rental. And the investment amount in these particular ones was between $200,000 and $1 million. And they were in metropolitan areas. This particular developer had investment programs ranging between 18 months and 3 years. I know that there are others out there that might have different types of programs as well. But a thing to consider is that, your retirement account can be an investor in these types of investments as long as the developer permits that. So it really does open the door to a lot of different types of investments with a self-directed account. A loan pool investment. This was a syndicator who pooled investor funds to create a loan, and then that loan was made to a developer of raw land. So where I live, there is a lot of development and building going on, and I see developers all over the place. So I could see this being an investment in my area. So a loan being made to a developer so that he can start developing the raw land, taking the trees down, clearing all of that, putting in the infrastructure before start building. So this loan was secured by the land. Those were the investments I wanted to talk to you about tonight. I do want to just enumerate STC's services. We are a full-service retirement plan administrator, and so we offer our clients that LLC structure setup I defined for you, that protected checkbook control, so you have our experts reviewing your transactions. We do have CPAs and attorneys available to answer your technical questions. We have a wonderful client services department to offer you unlimited guidance on transaction compliance. I really encourage our clients to talk with them, even at the beginning of thinking about a transaction, to making sure that, you're not entering any murky waters, no disqualified persons, no prohibited assets. So you can talk with them as much as you need for guidance. We handle all that back office administrative support I outlined for you. We maintain LLC financial statements for your retirement account. So you have online access to those, and you can actually go into your account and see where your cash is, look at all the transactions in your account online. We supervise that regulatory reporting, and we oversee the annual valuation. So we provide all that back office administrative support for your retirement plan so that you can focus on really finding the best investments for your plan, the things that you want to invest your retirement funds in. Now, just a quick checklist on how it would work to set up your account with STC. Talk with an STC representative. You can talk with me. You can call our home office. Review your current retirement account. Discuss what your investment objectives are. Get all your questions answered, and then complete our client paperwork package. Very straightforward, and we can help get you started with that right away. So how can we serve you? Perhaps you'd like to open a self-directed account now, or perhaps you have clients or colleagues who might be interested in self-direction, or perhaps you just need more information. Any of those things we would like to help you with. So you can check out our website at stcira.com. There's a great deal of information there, as well as some information from clients, so you can hear some of what other people have done and what they have experienced with STC. Our corporate number is there for you, and my direct email is there as well. So please do get in touch with us. We would love to help you answer your questions and help you get started with self-directed investing. So I want to open the floor for your questions. If you would like to type those into the questions box, I will open that up and look for those. And in the meantime, I will look for the couple of questions that I got in advance. Okay, just a couple of questions here. Does STC choose the terms of my loans? No, I did talk a bit about that. Really, you want to keep in mind, this is true self-direction. You will choose the terms of your loans. What our client services department will do is we will make you aware if any of your terms might raise a red flag in an IRS audit. As an example, if you were loaning money to somebody for 5 years for 1% interest, that might be a questionable transaction. So you need to keep in mind that the goal of your retirement account is to increase in value. I know that doesn't always happen, but that is the goal. So the IRS would wonder why you were going to loan money at that lower rate when nobody could get that from any type of lender. So we won't actually tell you need to change the rate, but we will inform you that you using those kinds of terms might be placing your IRA at risk. So you will truly set the terms. Okay, and another loan question. Does a loan I make from my IRA have to be secured? No, it doesn't have to be. The IRS doesn't require you to have your loan secured. However, you probably want to keep in mind that your IRA's investment is more protected if it is secured. One thing you do want to be sure is that in addition to having any collateral listed on a note, you want to be sure that the lien is recorded on the property. So that is something that you will need to do and take care of to make sure that it is secured. Are custodial groups such as yourself restricted to handling accounts within a limited region, or do you handle accounts nationwide? STC does handle accounts nationwide, and in addition, you can choose any state for the incorporation of your IRA LLC. We can discuss the various state options with you when you're setting up your account if you need assistance with that. So our operations department can help you with that. Okay, just a couple more questions I've gotten. If I want to purchase a bank-owned house, they often require verification of funds. How would I verify funds that are in my self-directed IRA? We are able to supply you with a proof of funds letter. So we would ask that you call us or send us an email, and we'll prepare that letter and email it to you in less than 24 business hours. What we would ask you to do is to point out the amount of funds that you want listed in that letter up to the full value of your retirement account. Obviously, the amount can't be more than the available funds in your IRA LLC the date the letter is prepared. However, most of the time, if you're bidding on a bank-owned property, you may not want them to know how much money you have in your retirement account. You might, put a cap on, I'm willing to invest X dollars. So that's the amount that you want proof of funds for. So yes, we can take care of that for you. And then, do I have to pay taxes on the income that is generated by my IRA? Normally, no. Generally, earnings in retirement accounts are tax deferred until you take qualified distributions, or if a Roth account, when you take distributions, potentially tax free. However, if you do use a non-recourse loan to purchase a property, then you will have to pay unrelated business income tax on a portion of the income generated from that leveraged property. That is UDFI, unrelated debt financed income, that is taxable. So there is a possibility if you do that type of transaction, or certain types of operating businesses could trigger UBIT, unrelated business income tax. I won't go into all the details of that. It is a complex topic, but we do have a previously recorded webinar on our website that you can get more information about that. Okay, those are the questions I have for tonight. Thank you for joining me. Please do get in touch. Check out our website. Call us or email me if you have any more questions, and we would love to be of service to you. Thank you. Good night.